Hey, it's Matthew Decker with Leveraged Wealth Management. I hope that you've seen by now that we've started a bi-weekly kind of 30-minute ESPN hot take style show. We're calling it The Show. And we did a really good segment a couple of weeks ago that I wanted to pull out and just play for you here with just this little intro and maybe an outro, because it's something that we've been seeing more of. And it's one of those situations where, man, if we could just get to you before you make some of these decisions, we can save you from a lot of pain. And so the segment that we're pulling out here that I just want to make sure that you get a chance to see is on this whole concept of being your own bank, be your own bank, or infinite banking. The idea that you're going to deposit most of your paycheck into a life insurance policy and then use that life insurance policy to live off of. I thought that it was a really good conversation, and I just wish that, man, if people could just see this before they say yes to things like these be your own bank sales concepts, I think you'd be much better off. So I'm going to play that clip here for you, and you can see exactly what we're talking about.
So they were the advice that they were given was, and we have seen this concept not just here, we've seen this a lot, so that's why we're talking about it to you guys today, is to basically take your combined paychecks and use that dollar amount as your monthly premium into an IUL, immediately loan it back out to yourself, and basically this idea of becoming your own bank, that the premium goes in, accumulation grows, it grows consistently every single year. It never goes backwards. And at the end of the day, when you die, the death benefit will pay off all the loans that you took, but you've got this cash flow that's accumulating over time.
Deposit my whole paycheck into a life insurance policy.
That's right. Deposit the whole.
Just wanted to make sure I heard you correctly.
That was the advice. The advice was then to, as you're loaning the dollars out each year to both live off of, you also could use those dollars to pay off any debts that you had. So this particular couple had a pretty significant real estate holding, and they were using this philosophy to pay the mortgages on these particular properties. They had to pull back what they were taking out. They couldn't put back in.
That's a high probability outcome.
They'd basically put 2 years worth of their income into the product. They had loaned out a little over 60% of the total premium put in.
Yep.
And they came asking for help. So talk to me a little bit about what do you wish you could have said to that couple if they had come to us before ever buying that policy?
Yeah, I mean, the first thing, the obvious thing is I would have said, hey, there's nothing that you should invest your entire paycheck into.
Yep.
Like plain and simple.
Mm-hmm.
You're going to take your whole paycheck and put it into one particular thing. Well, let's talk about that for a second. Why would you ever want to do that? Because I don't know anyone personally that thinks that's a good idea to be doing that with anything. So why is it that this is attractive to you? And if I would have been able to ask that question, I know that the answer I would have got back would have been a sales pitch, a regurgitated sales pitch.
Yep.
Well, I heard that it could do X, Y, and Z. I heard that if I did it this way, whatever, it's going to help me build wealth, or it's going to be a more efficient way, or I can cut the banks out of my life. And man, if you're being told, put all your money into one thing, that's probably some pretty poor advice, no matter what that one thing might be.
Yeah.
In general, that's really poor advice. So I think I would have just started there. I think I probably would have only had to ask that one question. And then after the regurgitated sales pitch, we would have been able to have a conversation about how these things actually work.
Yep.
And find out if it's even appropriate in the first place for them to be considering this at all.
Yeah.
But this is what happens all the time.
Right.
I mean, I'm not surprised by this at all. I'm surprised that they said yes. I'm not surprised that they were pitched this idea.
Right. Yeah, and it's one of those things that the IUL does have enough complexity to it. It almost can be, we hear a lot like, hey, if it's too good to be true, it probably is.
And this is primarily done with whole life, actually.
Yeah.
The fact that this was done with an index policy was even more surprising.
Right.
It's safer in a whole life policy, much safer, because if you're to deposit your whole paycheck into something.
Yeah.
Because there's no 0 years, right? And you're doing your whole paycheck and then you're loaning out every year for living expenses. That's not appropriate for any policy, but if you were to rank them in order of which ones would be safer, well, that would be safer in whole life. This is primarily pitched in the whole life world.
Right. And so the question maybe I'm trying to pretend I'm them. And it's obvious that whoever was giving them this advice did it in a way that was very believable.
Well, yeah.
You
They
know,
probably saw an illustration that showed them as multimillionaires in 10 years.
Yeah.
Because that's how the math works. When the situation is as fine as a razor's edge, and you're able to walk the razor's edge,
right,
then yeah, everybody retires a billionaire.
Yeah,
That's how it works.
We do have we have the ledger.
Oh.
I have it here. Because I just wanted the people to see that, hey, we're not making up this scenario. This is just a screenshot from the actual illustration that the folks provided us. And you can see they were maybe they got started late one year, but they put partial amounts in on year one, but then they were putting in their whole paycheck after year one, and you can see the 120 coming out each year in the form of a loan. And
so on paper it looks great. It looks like it works.
Right.
I put in my paycheck, I loan out all the dollars that I need, and in 15 years I still got $831,000 in cash and $3.7 million in death benefit. Like, why wouldn't I do this?
Right.
Why wouldn't I do this, Craig? Like, my gosh.
Yeah. Yeah, and the sales pitch would be is that, hey, take a look at the death benefit. At the end of the day, it's going to be able to pay off your loan. It's going to be increasing over time. Yeah. And so, again, you're just kind of cutting out the middleman of a bank.
What you're doing in this world is you are signing up for perpetual foreverness of $166,000 going into this policy. And so the minute that you can't quite pay the 166 that you put in, this becomes a problem because there are lots of fees in this policy. The death benefit's pretty high, $3 million for a 41-year-old. So the fees are going to get crazy. The minute that you can't pay the 166, it's a problem because you've already loaned out so much money.
Right.
You've loaned out $1 million inside the 10th year. There's no way that this works unless you can walk the razor's edge and do exactly what this piece of paper is showing you. And even then, it's not going to look like this when you throw in just a couple 0 years, which you will have.
Right.
You'll have 2 or 3 0 years out of 10. And now all of a sudden, you've got loan costs occurring with no credits. Maybe you can't pay the same premium, and you're 10 years down the road and you're going to have to take a bath, and it's going to hurt.
Yeah, this was a painful one of the more painful ones in terms of delivering news. But the good news in this one particular case, and advice if anyone finds himself in a similar situation, not guaranteeing that this will happen, but this couple was able to reach out to the particular carrier and talk to him and say, hey, if we just walked away right now, there can be some conversations around the loans being forgiven, and maybe if you got some surrender value left, that there's something to walk away with. There can be those times. So don't lose all hope, but those should be conversations that you have with someone that you trust and an advisor that can help you walk through those.
Anybody that's telling you to put all your money into something is someone that you should walk away from.
Yep. Yeah.
Plain and simple. So just to recap, if anyone is ever telling you put your whole paycheck into something, it's probably not a good idea. That's number one. And number two, whenever you're looking at life insurance as a wealth building tool or a tax-free income tool, you just have to be careful that you're dealing with someone who's being intellectually honest, who's going to explain to you the different moving parts of the product and make sure that what you're getting into is something that actually has a high likelihood of working. And anytime we see these, thin as a razor's edge illustration where you put in a couple $100,000 and all of a sudden it's generating millions and millions and millions of dollars for you, if it sounds too good to be true, it might be. And so I would just encourage you to take this slow, get educated. And if you want help getting educated on these products, you can start by booking a quick discovery call with us. The links are in the description below. You can go to our website, leveragedwm.com. Up at the top of the screen, you'll see book a meeting. You'll see IUL review. Both of those places will end you up with a quick 30-minute discovery call with us where we can just learn a little bit more about you, about what your goals are, about why you're looking at this in the first place, and ultimately help you figure out if cash value life insurance is going to be the right fit for you, your family, and your goals. Until next time, take care.